This episode is brought to you by Blockdaemon. You'll be hearing all about them later from me later in the episode, but now, on with the show. All right, everyone, welcome back to another weekly roundup edition of On the Margin. I am joined, as always, by my co-host, the talented Mr. Mark Yusko. Welcome to the show, Mark.
Well, thank you, Michael. And I am back to wearing some socks, so we'll do a quick reveal. Although it's today is kind of an optimistic day. I am wearing the Bitcoin Moon socks. When moon, and that's not to say that we're going to the moon. It's not to say I'm actually heading to Austin to sit on a panel tomorrow morning for Consensus, and I think the optimism of 20,000 people showing up to talk about this stuff is good. I just wish we actually would stop talking about just the price. And I think you tweeted out, or Yano tweeted out, wait, I'm not supposed to say his name. He who shall not be named, might tweet out that it's just about building, right? This is the time to focus on building stuff. So, anyway.
Yeah, I would have to agree with you. Mark, I think we'll know that we made it on this show when depending on what socks you put on, that actually moves the market. When that starts to happen, when we get a legitimate bump from whatever you think
that's right.
Socks are, that's how we'll know we made it. I'm glad we started optimistic because we've got a slightly worrying story that we're going to talk about. We're going to be talking about consumer credit and the personal savings rate. So give me
savings, oxymoron.
Yes, exactly. Over the last couple of months, obviously on CPI, but there was another very important number that came out this week, which is consumer credit. So what we're looking at here is total consumer credit that's denominated in billions of dollars. And it's broken out between revolving and non-revolving credit. So you can think of non-revolving credit as that's one-time credit events. That's like, auto loans, that's, student loans, things like that. Whereas revolving credit is something like a credit card, and that's an account that kind of just stays open, right? That's perpetually open. This has steadily been creeping up, since basically the pandemic. You can see an enormous, deficit in credit flows, which is basically when the consumer was repairing their balance sheet, they were actually paying down their credit cards in March and April of 2020 when they were really worried about the economy and the world and everything like that. And since then, it's just been a straight line up in the other direction to last month, which was a record month for consumers basically spending on credit. And the reason why this is worrying is if you put these two charts against, so we've got total revolving credit on the left here, which is basically at an all-time high. And then you've also got the personal savings rate, which is the amount of money that people keep in their bank accounts, heading to an all-time low. And you can see that these are inverses of each other. Again, that spike that we're seeing in this chart on the right lines up to this dip here on the first chart, which is basically when people were paying down credit cards, they were repairing their balance sheets. And now it seems like they're being, they're kind of doing the opposite, and they've essentially tapped out their bank accounts and are starting to spend on credit. So I guess, Mark, when you see these two charts together, what are some of the first thoughts that come to mind for you?
Well, the first thing is it was a natural reaction for an over-levered consumer to take some of the free money that was handed to them by the government and pay down debt. The smart consumers did that. Now, there were plenty of people who didn't, that sent the money off to Robinhood and E-Trade and tried to gamble in the stock market and felt really good when the meme stocks went up and now have lost everything. So that didn't really help. And now they're having to really dip into savings, well, what little savings the average person has, and spend on credit cards. And this is a really bad. I don't want to be overly dramatic. I'm prone to hyperbole, but this demands hyperbole. This is a crisis. And as we were talking pre-show, I'm afraid, I really am afraid that this is not unintentional, that this is an intentional crisis. I tweet about this relatively often, the dictator playbook. When countries get behind the eight ball, where they get overly indebted and they become crony capitalists, or even worse, cronyist or kleptocrats. And you get this group of people at the top who, they're super rich and they own everything. And what they realize, the only way out of the mess is to devalue the currency and therefore impoverish the masses. Well, how do you impoverish the masses and stay in power? Well, you got to give them stuff. You got to pay for votes. So you got to forgive student loans and you got to give free money during the pandemic. And that's what we are seeing. And it's not surprising that if someone hands you a check, you look around the house and you say, geez, I owe a lot of my credit cards and I'm a couple months behind on my mortgage. And, there was a period where you didn't have to pay your mortgage, right? That they basically said you can't be evicted. You can't be foreclosed on. So everyone just stopped, not everyone, a whole bunch of people stopped paying their mortgage, stopped paying rent. And then that went away recently. And now suddenly it's like, okay, I got to pay the mortgage and I got to pay. So the only way to do it, if you don't have cash, is to borrow. And we still, for some unknown reason, we still give uncreditworthy, and that's a harsh term. I mean, they're perfectly nice people, but when uncreditworthy just means you don't have the capacity to pay back the loan. And Michael, this is the thing that's been going on for decades is, when I was growing up, my parents, they knew the banker, right? The banker lived in town and there was a relationship and they lent you money based on what was called hedged finance, right? Bankers lent money with the expectation, right, of getting paid back both principal and interest. Novel concept, right? And you were hedged by the asset that you lent against, a house or a car or whatever. Well, then, the big banks kind of took over the small banks and the bankers were no longer in your town and you had the big nameless, faceless. And then we moved into speculative finance. And this was kind of the 90s into the 2000s. And not only did they lend you expecting to be paid, no longer did they lend being expected to pay principal interest, but now as long as you could pay the interest, right? As long as you can pay the interest, well, that principal won't worry about that. You'll sell the asset at a profit someday, except for cars, which depreciate, or boats. And so then we got into where we are now, which is Ponzi finance, where the lending's going on with no expectation of paying principal or interest, that there's just going to be a lot of defaults. And they kind of build it into their models and they jack up interest rates. Revolving credit is not, do you borrow at Fed funds? I always ask. I don't seem to borrow at Fed funds. And nope. I think credit card interest rates are still 20-ish%, maybe higher in some cases. So this whole idea that interest rates are low, well, not for this type of credit. And this is the highway, this is the super highway into economic misery. And that's why the misery index, if you ask the average person how they're feeling right now, I just saw this morning, ugly. 80%, I think, said that they feel we're going in the wrong direction.
You know what's funny too, as I was looking at this, I saw this commentary, well, expect APRs to go up, on your credit card debt. And it's like, well, have they been going down this entire time as interest rates have been on a one-way track to basically zero? Like, where has that adjustment been? But now that it's going back up, to still historically low levels, we should expect higher credit card interest. Okay,
yep.
That seems fair.
Crazy.
You know what? That's a really interesting point that you bring, kind of like the death of the small to mid-sized regional bank.
Oh my gosh.
I've been actually trying to put together an episode on this for a while, and I haven't found the right person to talk about it with, because if you look at the layout of banking in the United States over the course of the last 50 to 60 years, the story has been consolidation. As there have been basically little bubbles of risk that have popped up in different, usually credit-based sectors. There used to be savings and loans companies, right? And then there was the savings and loan crisis in the 90s, right? And basically the government's solution there was to have banks absorb, their credit and loans. And eventually, as there were smaller pockets of disturbance in regional banks, bigger banks just consumed them. And actually in 2008, that was the ultimate thing, right? Where there was an enormous amount of consolidation in the banking sector. Yep. Because the whole solution, right, to when bad loans are made and you need to absorb those assets, just to move onto a bigger balance sheet. And what that's meant is that the ultimate customer for those larger and larger banks have to be bigger and bigger. So as a small to mid-sized company, suddenly you don't have any banks really, that think of you as their customer.
Again, someone who might be prone to conspiracy theory might say that's the plan, right? That you choke off credit to the small and mid-sized enterprise. You create this massive set of oligopolies and monopolies. You give those large companies tax breaks in exchange for them buying back their stock, which is owned not by the average person, but by the rich people. Right? When did Warren Buffett buy Apple? Right before they announced this massive stock buyback program. Oh, and how did they finance that? Oh, well, they were given a cut in their corporate tax rate by the administration after they lobbied. So, again, it is, I think, part of a very large plan, and it's just not pretty for growth. I went on Mornings with Maria this morning at dark 30. I hate the 5 o'clock wake up call. I hate it.
That's early.
And 6 o'clock, bright eyed and bushy tailed on television, and they were showing the clip of Biden last night on Jimmy Kimmel saying that we have the fastest growth in the world, and I guess he did something like in the world, like almost like a Wayne's World kind of reverb, and it's like lying with incredulity is supposed to be a good feature of a leader. On no planet are we the fastest growing country in the world, and nor should we expect to be the fastest growing country. It's just math. We are the largest economy. The largest economy will not grow the fastest. Now, you could say that our economic growth, right, may be the incremental growth might be the largest. That's just the law of large numbers. You might be able to say that, although I'm not even sure that's true because China's is probably bigger than ours. But this nonsense of rah us and China's evil and I don't know, just the whole thing smacks of, I say, desperation. And this whole idea, I tweet about this too, is repeating a lie over and over as if it is the truth does not make it the truth. It is still a lie. And even if people believe it, it's still a lie. Like if I just told you over and over again that I was 6'4" and I sort of sat up straight and I looked tall sitting down, and everybody, it's so funny. Zoom has made me just a total. I can't judge anybody's height anymore. And I meet people in real life, and they're either super tall or short. And I thought you were all the same height because we all look the same on Zoom.
Yeah, that's a recurring theme in Blockworks. We keep hiring tall people, and we don't know it until we actually see them in person. So it's like, a huge amount of the company is over 6 feet. I'm with you there. But walk me through, because I think the reason why we're zoning in on this particular issue, right? And I think there are two ways to interpret this kind of gorging that U.S. consumers are spending on credit cards. One, you could look at it as a very unhealthy sign, right, of just the consumer balance sheet, so to speak. And we've got some contrary data that I'm going to get to in a second that show why these numbers might not be so bad. But basically, one way you could look at these numbers and say, wow, this is really bad. We're approaching a recession, and consumers have basically tapped out their personal savings, and they're starting to live off their credit card, which is obviously very bad. Another way that you could look at these numbers, though, and this may be the bearish case, is that the Fed overall, they're trying to take liquidity out of the market, right? And what they want to see is actually contracting credit, because they know that they need to cause a recession to kill this inflation, so they don't get that death wage, price spiral that everyone's so afraid of.
Well, they think that will work.
They think it'll work.
It isn't going to work, but they actually believe. This believe. Is the crazy thing, as you described perfectly, their thought process. They actually believe that by raising interest rates and choking off credit and I said killing off a whole bunch of businesses that are over-levered and a whole bunch of consumers that are over-levered, they actually believe that somehow that's going to solve the low production of wheat globally this year and the inability of ships to get in and out of China ports to fill up with goods to bring back. Nothing that they do will impact those things in any way. it will not change the price of natural gas from 950. It won't. You
Yeah.
can raise rates to 20%. That will not change the fact that we have underspent on infrastructure in oil and gas, particularly in pipelines. It just won't fix that.
I agree with you, but I think the meat of the question here is because the Fed could look at this creation of they might look at this as the creation of credit, right? And if people are still creating credit by spending, they say, ooh, we haven't gone far enough, right? So there are basically two lenses that the Fed could look at this data. They could say, wow, we're really concerned about the consumer. They're about to tap out, which is a phrase you hear a lot. Consumer's going to tap out. I don't really know what that means, but people are saying that a lot. Or you could look at this and say, actually, the consumer is still spending. We haven't been draconian enough with our interest rate hike. We need to keep hiking until the consumer stops essentially spending on credit. How do you think the Fed is going to look at this data and react to it?
I think it's, again, a really important insight. And as always, you're doing what we're supposed to do, right? We're supposed to ask questions. We're not supposed to just report facts, particularly facts that have already passed, and say, oh, see, we told you. It's to ask the questions going forward. And that is exactly the question, which is how is the Fed going to react to a change in behavior? And this again harkens back to the Volcker problem. Volcker, he's hailed as this big hero and he broke the back of inflation. Well, but the first part of that story is he actually caused a bunch of the inflation because of some bad feedback mechanism in calculating CPI, because it was double counting mortgages and housing prices. And so he was so sure that he should be doing this, even though he was causing his own problem. And I think the same thing is true here is if you're looking at the wrong data, you may make decisions that are antithetical to your stated goal. I think the Fed, and we've talked about this, is in a box, right?
Yeah.
There is no way out. I mean, they can't keep rates where they need to be to stimulate demand so we can grow our way out of this because of the perception that they caused the inflation. They didn't cause the inflation, right? You know who caused the inflation is Saudi Arabia. Saudi Arabia could easily crush oil prices 50% without even trying hard, right? All they have to do is produce what they were producing 3 years ago, but they decided not to do that. Why did they decide not to do that? That's a whole nother conversation for another day, but they could. And China could clearly open up their ports and get the supply chain fixed, but they're not doing that. So the Fed has no control over those two things. Zero. Nothing they do is going to change those two problems.
This episode is brought to you by Blockdaemon, the world's leading blockchain infrastructure platform. Blockdaemon's mission is simple. Make spinning up a node so easy a 5-year-old could do it, and so secure that any chief compliance officer in the world could sleep easy at night. In plain English, Blockdaemon allows anyone, whether you're a crypto native fund, a financial institution, a DeFi protocol, whatever, to participate in crypto more safely. For some, that can mean participating in governance. It could mean gathering real-time and accurate data. It could mean generating yield through staking. Whatever it is, when it comes to crypto, infrastructure is edge, and there's simply no better edge offered than the one from Blockdaemon. Blockdaemon supports a range of services on over 50 protocols, and that's a growing list. They have multiple layers of risk mitigation that include regional and data center diversity, 24/7 human and automated monitoring, a full-service team of engineers to avoid technical difficulties, and things like slashing insurance. In other words, they literally make it foolproof. If your organization relies on real-time, accurate data that comes from blockchains, please click the link at the bottom of this episode and go check them out. Again, it's important. Gotta click the link at the bottom, otherwise I won't get my credit. I'm curious to just the devil's advocate argument to that is, they don't have any control over, right, the cost of oil. They don't have any control over the ability to produce wheat, et cetera. But what they can control is obviously the demand side of the equation. And, one of the things that you and I have talked about a lot on the show is the wealth effect. So when they lower interest rates, they increase the price of financial assets like housing, right? You can see these an enormous amount of increase in the price of housing. That leads to tappable equity lines on those housing, and people just feel wealthier, so they want to spend more. Shouldn't, in the reverse, right, when they raise interest rates, the value of their homes go down, the value of their financial assets go down, everyone feels poorer, so they're not spending on these things? Like, can't they kill demand? You don't think that will have an impact on inflation?
Well, I mean, so let's think about this. So gas prices have gone from $2 to $5 over the past 18 months or so. And how much has driving shrunk? Not much, right?
No.
Well, why is that? Well, because in order to do your job, you got to get in your car and drive. You just don't have a choice. Now, some people are working from home, but there's a certain number of people, truck drivers, gas station attendants, nurses, teachers, that they don't have a choice, right? So there's a base level of demand that isn't going to change. The other thing is oil and gas usage globally. Everybody focuses on transportation. Like the woman last time, oh my God, the senator saying, well, I got my new EV and I drove here from Michigan and I passed all these gas stations. I just didn't care. Like, well, right, but the average person doesn't have $70,000 to buy a Tesla. They don't. And you can't get one right away, but they just don't have that. And they can't buy that. But the real problem is not that. It's that transportation is only a small part of oil usage. Right? There's all kinds of other things. Petrochemicals. Everybody's like, oh, I want us to be carbon free. I don't want us to use oil. Okay. You can get rid of all the plastic in your house. You can stop using rubber. There's so many things that petroleum goes into. And then you got the other piece of it, which is natural gas. How are we going to kill that demand? Are we going to change the weather? Right? The real problem is the supply, not the demand. We have supply constrictions, both artificial and man-made. Both natural and man-made. Natural meaning we didn't invest enough in the production of gas for Western Europe, so they're reliant on Russia. And then in the US, we had a whole bunch of bankruptcies in the oil patch, and we haven't seen enough reinvestment. And then we do stupid stuff like, reverse leases. The administration just reversed a bunch of leases for drilling on federal lands. So again, I hear you on the demand side, but I just don't think we have a demand problem. I have said this for a long time. The inflation that everybody's worried about is not demand pull inflation. It's not like the 70s. It is not that we're demanding too much. It's that the supply caused the problem. And that can't be fixed with interest rates. Yeah,
I would agree with you. But I do think, on the one hand, that I do think the Fed is genuinely concerned about this, right? Like you can almost sense, you can sense central banks are worried about this. And you're starting to see surprises like the Australian central bank, right? They surprised to the upside, right? They did a 50 basis point hike instead of people are talking about 25 to 40. Indian central bank is turning more hawkish. So, in general, I think central banks are starting to take this seriously. I think the question that everyone is asking is, people talked about the Fed put for a while. Okay, maybe the Fed put doesn't exist at the level that it currently exists, but what are the things that are going to cause the Fed to say, hey, we might have gone too far too fast? It's basically when things start to break, right? So the thing that everyone wants it to be is when equity prices fall to a certain level. It doesn't seem like it's going to be there. Yeah. It seems like more the focus is going to be on credit markets, right? So we haven't seen spreads blow out really yet. That's actually because
I think it's the election. Right. I think everybody, particularly people watching things like this, really want it to be financial assets, either crypto prices or stock prices or high yield prices. But it's really the election. The election is really important, and it's really important because people like to stay in power, and the only way you stay in power is if people aren't really pissed at you. And right now, people are really pissed. And in the absence of a material fall in oil and gas prices and a material recovery in kind of consumer confidence. I mean, consumer confidence is plumbing lows that we see at recessions.
Yeah.
And everybody says, well, we're not in a recession. Well, first quarter GDP was negative. Second quarter GDP estimates have fallen all the way down to 0.8, which margin of error says that could easily be negative. And so, and not that 2 consecutive quarters equals a recession. That's not the way it works, contrary to popular belief. It's actually the NBER determines when you have a recession based on 4 big indicators: industrial production, retail sales, employment, and I always forget the 4th one. But we'll see what they say. But it feels to me, other than the ebullience of certain segments, like I said, 20,000 people are going to Austin, Texas to party this week. Okay. That's not recession-like. But that's 20,000 people out of 360 million. You go to, I think, I don't know if we talked about this last week or not, but no, we couldn't have because I just did it last weekend. I went to a lacrosse tournament last weekend and with my son, my 11-year-old, and there were 50 teams from all over North Carolina that came and bought hotel rooms and spent a lot of gas money because they all drive giant SUVs. I had the littlest tiny car, with my little Kia, and everyone else is in these monster SUVs. And so that was impressive to me. There was a lot of consumption going on. People went to restaurants. We went to this one restaurant, hour and a half wait. Now, granted, it was a Saturday night. Granted, it's on the lake, Lake Norman, ritzy place with all the NASCAR money. But still, that wasn't recessionary looking. But I do think it's the top end is still fine, but the bottom end, man, look at Walmart numbers, Target numbers. Those are real.
Yeah. I would say too, we just did permissionless as well. And I heard a lot of people saying, look, there's still so much positivity and et cetera. And what I would say is I'm remembering back to 4 years ago, the biggest consensus event, right? Which at the time there were no other events. It was just consensus. The biggest event they ever did was actually in May of 2018. And that was like 5 months right after, so at the very beginning we were already in this bear market, but it had already started. And I just think sentiment takes a little while to catch up. It feels like we're not at the bottom yet, just because of there is still like hope, and we've passed the anger stage into the none of this stuff really works phase.
Again,
I'm talking now specifically about crypto,
genius analysis, right?
It just lags a little bit.
The lag effect. No, that's exactly right. Particularly human beings, because we don't like reality.
No.
Reality sucks, particularly when reality affects your personal balance sheet. Or income statement. And, we are in crypto winter. We are in a bear market, right? There's no debating that. Yet, to your point, 25,000 people down in Miami for the Bitcoin conference, however gazillion many you guys had permissionless, 20,000 people going to Austin. There is this belief that, we're past it. And now we're going to have this big rally. And I'll tell you, I'm so nervous. Looking at the chart, the Bitcoin chart in particular, it looks so much like that period right after you described. June, July.
It does look a lot like that.
Kind into November. So there was about a 4 or 5 month window where we bounced around 6,000 over and over, and each bounce was lower. We went 12, and then we went 10, and then we went 8, and then we went 65, and that descending triangle pattern is a horrific pattern. It is not bullish. It is, and you remember November 14th, bang, we were down 50% from 6 to 3. Not quite 50, but I think we went to 3,200. And that was the bottom. That was the cathartic, oh my God, okay, I got it. And that's when you know, I remember we issued our Morgan Creek Bitcoin challenge, right? The $1 million charity bet that we would take, Bitcoin. Anyone else could take the S&P for the next 10 years. We got crickets. We actually had one person did say he would take it, as a famous money manager, and his son talked him out of it. He's like, Dad, no, we are not doing that. There's only downside for us. I mean, we're in the traditional asset management business. So he didn't take it. But it's a good thing too, because, right, Bitcoin's up 10x from there.
I love when you guys did that. Yeah, should have. I mean, even now, I would take that bet. The Bitcoin.
Oh my God! Right now, let's issue it again. The Morgan Creek, Bitcoin challenge. Anyone listening to this? Jim. I wouldn't do it against Jim because I like Jim. But anyone in the traditional world who wants to take the S&P over the next 10 years, you know what? Dang it! I should have done that on Maria's show this morning. I should have done that.
Hey, we have a bigger viewership than her anyway. So
you know what? It's probably true. It's probably true. It probably is true, especially at 6 a.m. I know we have bigger viewership than Maria at 6 a.m.
100% higher quality viewers, all you listeners. All right, I've got one
that's
more.
That's not even close. Definitely higher quality.
100%.
Because these people actually care about stuff beyond politics.
I've got one more question for you about, or just line of questioning around consumer credit before we move on. And I did want to present as well, just kind of the devil's advocate here, because the flip side, right, of everything that we're talking about, there is some data to suggest actually that, this is not, as bad as many like this. So the two data points that I think are worth pointing out is, would you basically have on the left here is credit card spending versus debit card spending. And you can see that, the idea just being what are people spending in terms of credit versus what are they spending in terms of cash they actually have. And that hasn't changed overly much in the last, let's say 2 years. We're showing, May of 2019, May of 2021, and May of 2022. It's about the same. And then the other thing too is that we're looking at the household debt service ratio, which is something that people pay a lot of attention to. And that's actually at pretty lows. So, right, that's as a percentage of people's disposable income, how much do they have to pay in terms of their mortgage each month, and that's going down. So I think that's why people are not. That's the flip side to everything that you and I just said. I would say one other area to just be aware of, for consumer credit, is the buy now pay later phase.
Oh yes.
So this is a pretty interesting area, but maybe you guys have seen this when you're checking out now from something like any of these like e-commerce kind of sites. You have this option to don't buy now. You can buy now, but you can pay later, right? And there are these companies that have sprung up like Affirm, Klarna, et cetera, that have gotten like screamingly high valuations. And basically the idea is that in the same way that you can take on debt to buy a house. You can finance purchases of increasingly small consumer items, right? And I think this really kind of got started too. It got started way before this, but that you can kind of see that making sense with like a Peloton, right? But now, you can literally do this on like $100 purchases, right? So it's very, very low. And this is still a relatively small, part of the market. But there's an estimate that for 2022, there's going to be, over $180 billion worth of items that are bought, financed essentially in this way of buy now, pay later. And one of the tricks about this is that, the business model for these companies like the Affirms of the world, the Klarnas of the world, is that they're securitizing this debt essentially, right? They're packaging it in the same way that they did for in the great financial crisis where they had a bunch of different tranches of mortgages. Remember that they paid these CDOs. They essentially securitized the debt of these consumers, which no one is doing credit checks or anything on these, and they sell these. And crucially, that data is not included in this consumer credit data that we've been reviewing. So, it's hard to know this. I was really digging into this, but it's hard to know if this is like subprime data. It's getting tossed around that comparison, but it's certainly not. You wouldn't call it solid. You wouldn't call these people solid borrowers, right? And it's something like 42%, in a firm's case, have like missed at least one payment, right? So it's not very solid data. I'm curious, Mark, if you dug into the buy now, pay later stuff.
Thankfully, we avoided the mania around this. These stock prices went straight up, and all the hedge funds jumped in, and now they've gone the other way, and they're down 75, 80 plus percent. It's like most things in life. This is not new, right? I mean, what is a credit card? A credit card is buy now, pay later. And,
Yep.
This is just taking it from an unknown schedule that you determine, right? You can determine how much you want to pay on your credit card to, okay, now you're going to have these 4 payments set up on a periodic basis. So I don't really get the allure. I guess it's a little better UI UX, and it seems like it's something new, but I don't get it. I mean, to avoid paying credit card interest, you're paying interest to these companies. You realize that, right? I mean, I just don't understand. I mean,
So guys, for those of you who are just following on via audio, sorry, Mark, this is a chart this is a poll that was done Insider Intelligence about reasons why U.S. consumers use buy now, pay later services. The top 4 reasons. Number 1 is to avoid paying credit card interest. That's about 40% of people. 2, to make purchases that otherwise wouldn't fit my budget, which is 38.4%. Not great. 3, to borrow money without a credit check, which is about 25%, which is also not great. And 4 is just, I don't like to use credit cards. So I'm kind of with you on that. But I mean, you can see, so maybe to extrapolate here, because the reason why everyone loves these business models of buy now, pay later is because essentially when you include that as an option, the cart size goes up, right, on an e-commerce site by like 40, 50%. That's why it's so alluring. And actually, the other thing that we should talk about as well, this just got announced with Apple's big thing, is that Apple is getting into the buy now, pay later space. I don't know if you saw
for
that.
sure. And I guess now that when I think about it, I misspoke. It's you're not paying interest per se, but you are, in the sense of the companies will, because someone's paying the interest on the money, right? So someone's borrowing the money to give to the company, and then, to your point, they package up the loans and they tranche them out, and so there's a financial engineering that's going on. And I guess the thesis is that the cost of money to those big borrowers is lower than using a credit card, which is true, but prices will adjust to recapture that amount that you're losing, because you're paying the cost of acquisition to the tech company. And so over the long term, I don't believe you save money. It's like, the layaway process in the old days. When I was growing up, you put it behind the counter and then you paid for it over a period of time, and then you got it at the end. Now you get to take it with you and use it while you pay. But I don't know. I'm very suspect of anything that finances, to your point, low quality borrowers.
Right.
And that's a mean thing to say, but it's just fact, right? I mean, if 38% are saying it's to buy things that I really can't afford, just think about that sentence. It's like somebody tweeted at me today. I said that tech valuations were still too high. He said, "What are you talking about? Amazon's only selling at 55 times. That's low compared to the last 10 years." I'm like, are you joking? Can you read what you just said?
Okay. This is a really good point, and actually something that I keep hearing. And, people keep talking about it's like, okay, I've been listening to, there's a guy, Brad Gerstner, who's a really smart guy. He's founder of Altimeter Capital, really sharp hedge fund. As far as I know some of the folks there, and as far as I can tell, they're real sharks, really smart guys. I listened to him talk about this idea of, we aren't there yet, but eventually, by maybe fall of this year, investors will feel comfortable underwriting to the 5-year average. But I'm just sitting there thinking, in my mind, the absolute worst case that we're talking about here is underwriting to as if we just continue to grow on the same trajectory that we've been growing for the last 13 years. It's like no one can even mentally prepare for the idea that it could go lower than that, right? That's not how, because that's not how it works. It corrects to the upside, then the downside, then we go back to the average.
But the worst part is again, people just can't, and it's not their fault, right? People only use short periods of time, like the last 10 years. Oh, that seems like a long time. First of all, that's not a long time. Second of all, that data is polluted by QE, right? Because we held interest rates down, that boosted people's perception of the future value, even though low interest rates are a sign of economic weakness in the future. So you should actually discount, not expand. But the joke of it is that to say that for 10 years we were idiots to pay 100 times earnings for companies, okay, which has never been a good idea, or 20 times revenues, or even 100 times revenues in some cases, and that 55 is lower than that. It's like no. What's the growth rate of that company? What is the growth rate? Is it 5%? Is it 8%? Is it 10%? It sure ain't 50%. Amazon is not growing 50%. It's just not. Apple is not growing 25%. And yet the PE is still 25. And you can engineer Amazon, oh, we split our stock, so yay, we're more valuable. Are you joking? A stock split doesn't create value, doesn't destroy value, but doesn't create value. It just gives you this illusion that, oh, well, the stock price has to go up because number only go up. Well, right, but number go up could also include, and will also include, and I'll argue we are there, a 10-year or longer period, 20 years if you're a Microsoft or Cisco, where you don't get back to the old high.
I thought just on your idea about stock splits, I don't know if you saw Shopify announced a 10-to-1 stock split.
Of course they did.
And I was just like, that's the solution? The stock's down like 90%. And it's just like, oh, we'll do a stock split. I mean, I don't think that's going to keep working, not like, when Tesla announced its stock split and went up like 10% that day. I just don't think we're in that environment anymore. But
look, at some point, madness wears off. The problem is people go mad in crowds and they only come to their senses one by one. It's not like we all wake up and say, oh, geez, paying 55 times for something growing 20% is a bad trade. We just don't get there. And, Tesla, another one, right? I think it was up this morning for some reason, like their production in China went up. But the valuation of Tesla still sucks. And it's down a lot from where it was. And people say, oh, but it's still up over the last. And I'm like, yeah, I got you. But trust me, when we're done with this cycle, and we're not done, when we're done with this cycle, this economic cycle, and we have the recession, and we have the cleansing, and we have the credit spread blow up like you talked about, when all that happens, we will look back and with incredulity, we're like, oh, we knew that was going to happen. Like, well, but you didn't prepare for it, and you just held all the stuff that went down. So whatever.
Yeah, I've noticed that the further away you get from these sorts of crises, the more everyone just says I was on the right side of that, even though no one at the time ever does.
Revisionist history is unbelievable.
If you just took people at their word, the way they talk about it, everyone was on the right side of the great financial crisis now. And
100%.
And this is a bother with me about Terra too. It's like, look, I understand the pressure to not say negative things in crypto. I think it's a kind of a problem in crypto in general. But like the way it gets portrayed is like everyone knew that this was a Ponzi that was gonna collapse, and it's like that's not the case. Like I've been around here, I've been paying attention. I mean, I know there were concerns, and some people did voice those concerns. Gigantic rebirth, Galoy, but I just want to tie the bow on this whole consumer credit thing that we're talking about. Then we've got one more hedge fund story that I want to move on to get your take on. But in general, what I'd love to know is, because you could look at this consumer credit. I just want to know how you think about consumer credit here. Is this because on the one hand, you could look at this and say, hey, we're heading into a recession, which means that people default on things like credit cards, and that could cause some sort of cascade, right? That could be the whole credit system is interconnected, right? So what you definitely don't want is a whole bunch of defaults, banks taking losses, et cetera, especially in a time that's pretty bad for banks in general. The other way that you could look at it is to say, again, the Fed will look at this and say, credit is still being created. Look, people are still spending. We're not doing enough. So what is the way? Like, should we be worried about some sort of contagion with a bubble in consumer credit? Should we say, hey, the Fed will still look at this and say, hey, we're not going far enough? Like, what's the bow here that we should be looking at this with?
So again, the analysis is perfect. It's both, right? I mean, both are going to happen. The Fed is going to interpret incorrectly that rising credit creation, even if it's subprime credit, and even if it's a net negative in the sense that you buy a wasting asset on credit, paying high interest rates, so that asset depreciates in value, right? You're not buying an appreciating asset like a house or a collectible. You're buying things that get used up, like food. You consume it, or like a movie. It cost me $20, which was worth every penny to go to Top Gun Maverick and IMAX. Don't see it any other way.
I heard so good.
So good. I mean, so good. But those are wasting assets, and then you got to pay for it over a long period of time, and you're going to pay rising interest rates. So yeah, the Fed will make that mistake. But then on the flip side, to your point, the defaults will happen, right? I mean, when people borrow too much on credit cards, the nice thing about a credit card, you can default without that much pain. I mean, in theory, you got to do the personal bankruptcy and all that stuff, but even that isn't like it used to be. It used to be 7 years in debtor's prison, and you just couldn't get any credit. Now you can get credit within like 18, 24 months. Yeah. So, but that definitely will happen. And then there'll be the contagion effect. But I don't think we're going to get there. I don't think we're going to get to the extreme, because I think the Fed's going to pivot right before the election. They're going to try to save the Dems, which I don't think they'll be able to, but I think they'll try. And I think we're going to have a reversal in policy, and we will bail out the worst of the worst again, and we'll just extend and pretend. It's funny. We're clean. My son is 11, and so he just yesterday graduated, which I didn't know you could do, from 5th grade. So he's off to middle school next year. And so to celebrate that, he gets to move into his older brother's big room. So he's been in the little room.
Congratulations, Will.
Now he gets the big room. And so we were, going through his stuff and what do you want to keep? And he had this whole bunch participation trophies. And I've told the story that the first one he got when he was 4, I brought home, and his team went 0-10, and I took it and put it in the trash. You don't get a medal for 0-10. But he had a bunch of others, and he looked at him and like, no, throw them away. And like that's where we are. We're still in that participation trophy world, and we don't punish the bad actors. We don't. We celebrate the nonsense. Like, how many people spent time watching this stupid trial? Oh my God, it makes my head hurt. So,
I think the last note I want to close, just what you were saying there reminded me of, is with the buy now pay later thing. I think one of the reasons too why it's just not great is because debt isn't bad as long as it's productive. Right? Like if you take on debt honestly, for a house or for a company or for whatever, I mean, that's, if you can produce more cash flows to service that debt, then that's a good thing, right? You go all the way back to Alexander Hamilton. He believed in, some amount of debt. There's just a line somewhere. And honestly, a lot of the assets that people are, the stuff, I'm not going to call it assets. It's stuff that people are buying. You're not going to get a return on, I can't think of any consumer. Whatever,
buying
like your
appreciated
AirPods.
assets.
You're not going to get cash flows from the AirPods that you're financing.
No, again, buying appreciating assets with low cost debt is what rich people do. Mm-hmm. Think about it. That's what rich people do. They own multiple homes. They own appreciating assets like art and commodities, and they finance it with really cheap debt. That is productive. That is productive. Buying wasting assets with high rate debt, consumer debt, is a recipe for the poorhouse.
All right, I want to move on to this last story here because I want to get your take, something more in crypto land, but also just about down rounds in general. So story kind of broke this week, right? That BlockFi is raising a down round at $1 billion valuation. That's down from the last valuation that they had, which was $3 billion in March of 2021. Yep. 3.8.
3.8.
Now, I mean, we could either talk specific. I mean, you and I have talked about BlockFi in the show. I'm going to say my personal opinion here. I'm a big fan of BlockFi, so we could talk about them. We could talk about.
No, we can talk about it. Look, we're the second largest owner, and I love this company. I think that this is a steal at this valuation at 2 times revenues, compared to a lot of public companies at still 15, 20 times revenues. You know, paying 2 times revenues is a really good deal. But look, the average down round, I believe, is coming 80%. 80. And there was a tweet this morning. I don't know if I retweeted or not, but it was a analysis of, GoPuff and a bunch of other big companies that, all the big glitterati venture funds did 6 months ago. They're all going to be down 50, 60, 80%. And it's real. And look, Keith Raboy tweeted about this 6-8 months ago. And whether you love him or hate him, this was cool in that he said, yes, we've all lost our minds. As an industry, we're all overpaying, but you go first. You cut your valuation first and get excluded from the deal. And the rest of us will do the deal, and then I'll follow you. Nobody wants to be first. And look,
that's a great quote.
Am I happy that the valuation is down 75% from the last round or 74% from the last round? No. Am I excited for the future of this business that I think is going to be one of the dominant players in the space? Absolutely. Am I going to participate? Absolutely. But yeah, it's more are coming, and the good news, and nobody likes to hear this either, and I'm going to say this on stage tomorrow, a whole bunch aren't going to survive, and that's not a bad thing. What we need is to get the bad ideas away and not allow them to drain human capital and physical capital in, and we need the displacement to happen and for people to be displaced, right? Gemini's laying off 10%, and other companies are laying off 10%. And that's a good thing. And I go, wait, no, people losing jobs is not good. And I don't mean it in a mean way. And I'm, touch wood, I still have a job. It's not about that. It's that downsizing is necessary. And those displaced people, in many cases, go on to do amazing things. Some of the best investments I have ever made in my career happened in the depths of bear markets, backing people who were displaced and had to do something unique, innovative, creative. And so this is the time to build. And it's necessary. Winter is necessary, and it creates spring and summer.
Yeah, I would tend to agree with you there. I've got a specific question for you on, because you hear these awful things about down rounds, right? Like avoid at all costs. It's really bad. Yeah. Why is it so bad? And if you could talk specifically for the employees as well, just because equity is a very confusing thing, especially in startup land, and is often not very transparent. And as an employee, sometimes depending on how your equity is structured, you're very junior on the cap table, right? So your equity is kind of the first to get wiped out.
Absolutely. Look. Down rounds are bad for lots of different reasons. I mean, one, just the psychological effect.
The psychological impact.
You thought you had this great wealth, and now you don't. Now, Sam Walton used to say this all the time. It was paper yesterday. It's paper today. It'll be paper tomorrow. So people who spend it like it's real, that's a mistake. It's paper. And until you convert it to real money or real value, it's not real. And one of the things about venture I like to say this even to my partners, that venture is not about what you got. It's about what you got out. So all of us felt really smart 6 months ago. Oh, look at how these high valuations, but they weren't. I didn't get the cash back. And we did take some chips off the table, and we actually sent back all of the money from our first fund to our investors within 3 years. That almost never happens. And I feel really good about that. And so now we have all profits to harvest in the future. But we didn't sell everything. And our valuation is going to go down. And that's okay. But for employees, it's bad. One, psychologically. Two, the way stock compensation works is you got all these options that are struck at probably higher prices, and now suddenly they're out of the money and they don't have as much value, and you thought you were getting paid a lot, and now I'm not being paid for my value. So that's a problem. And so then it also forces some people then to do some secondary transactions to fund lifestyle, buy a house or whatever. And so that then pushes the price down because people are like, "Whoa, you need liquidity? I'll give you liquidity, but at a price."
Yep.
And then the last piece of it is preferred stock. Venture capital firms come in layers of preferred, like the old Jello molds, right? It was clear on the bottom and then got cloudier with the different things, and it made the layers, or like a layer cake. And the last money in has what's called a liquidity preference, meaning in the event of a really bad outcome, like a liquidation, if something really bad happens, those people get paid, and the people at the bottom, the common shareholders, management and employees, get bupkis. I mean, think about this: $500 million company, suddenly a down round to 100 million. Okay, the VCs have 100 million in with a liquidity preference. It gets sold for 100 million. Some person comes in and picks it up on the cheap. The VCs get 100 million, and everybody else gets nothing. It's like, whoa, 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 whoa. And so, yes, you want to avoid down rounds, but the reality is market valuation matters. And when the largest public comp, Coinbase, went from 10, 11 times revenues to 3, guess what? Every other valuation is going to go down.
Yep. I think that's very well said. And I think that, for those of you who haven't worked in a startup, the psychological impact is I can very clearly understand why that would be so disheartening. And, you can say that there's a great quote from Sam Walton: paper tomorrow, paper today, whatever.
Paper yesterday, paper today, paper tomorrow.
Yeah,
it's just
right.
paper.
But
paper.
people just won't live like that. People continuously, that's what makes it very difficult to compensate with equity, actually, in general. I think it's just a challenge of human psychology.
It's a super big challenge. And look, it's even more challenging because we went 13 years without cycles. So we didn't have to deal with this. It was just number go up. Not crypto number, but just economic growth, valuations, everything went up because they held interest rates down. And back to the Fed, it's the root of all evil. And, rest in peace, Rudy Havenstein. He was kicked off Twitter and, God rest his soul. I mean, ridiculous. But the guy, ETF and the Fed, look, the Fed's been causing problems for 109 years. And it ain't going to stop. And we are now in a place where the cycles are returning, and they might return with a vengeance. And, kind of like Die Hard with a vengeance, right? And usually sequels are bad. That one was not bad, but not as good as Maverick, Top Gun. Awesome sequel. Amazing.
I can't wait to see that.
Oh my God. Oh, Michael, I'm ready to go again. I was ready to watch it the second time on the day of the show, but it's so good, so well written, so well acted. Tom Cruise is, I don't care for his life and weird stuff, but the guy as an actor, amazing. Amazing.
Okay. Maybe it's a hot take. Tom Cruise is like one of the last real movie stars. That guy is a freaking movie star.
Movie star.
First of all,
movie star.
First of all, he's aging in reverse. Whatever weird voodoo he's got going on with Scientology.
Yep.
I don't know, man. You can knock it. Something's working for that guy.
It's working, baby. It is working. Well, most of it is what you put in your mouth or not put in your mouth, and working out, right?
Yeah.
And that's the big part. But there may be something else. But it's working, and I don't know, the joy of that movie. I mean, there were periods in the movie of just pure joy. Like, he wasn't acting. He was just living. And it was awesome. And the scene with him and Val Kilmer almost bring a tear to my eye right now. It was just so good. And so it's amazing when an actor is no longer acting. Like, that he is that person. Mm-hmm. I don't know. It's just, but I agree with you. I mean, Humphrey Bogart, there aren't many that you would say, you know.
He carries a franchise, man. He's so dedicated to the craft. Yeah, that's what I mean. He's like Blockbuster. He headlines it. He's in the fighter craft flying, like on the Mission Impossibles. He's hanging out of the plane. I mean, how could you not respect that guy? Okay, and here's the other thing. You know, everyone thought he was a weirdo because he like hopped up on the couch or whatever during that Oprah interview. Yeah. Think about if he did that today. That wouldn't even be the top story of today. You know, he just went a little nuts 15 years too early. You were ahead of your time, Tom Cruise.
That's right. As usual, ahead of your time.
Would be like, that doesn't even matter. Doesn't even make it'd be like, wouldn't even be the top story of a 24-hour news cycle today. So I definitely want to see Maverick. I just haven't had the chance to do it yet. But
all right, do it.
All right. That's all the time we've got today, folks. We got to wrap. Mark, as always, best hour of my week. I will see you same time next week, my friend.
All right.
Cheers.
Have a good one. Thanks, y'all.
You too.